Today, rate rise, Endgame? Hi again, it's Martin North from Digital Finance Analytics, one that is post covering finance and private news with a distinctively Australian flavour. It's a steamy, hot Friday afternoon, ideal for Tarric. Hi Tarric, how you doing?
Oh, not too bad, mate. Just a bit warm with no fan on, so we can actually have some audible audio.
Yeah, I know, it's a bit like that. It's certainly a warm day today. The dogs refused to go for a walk earlier on. They sat on the steps saying, go on, if you want to go, you go, but we're not going, it's too hot.
Oh yeah, it's just one of those days. But there's at least there's plenty to talk about.
There certainly is. And of course, we've had rate hikes from the Fed, 25 basis points, the Bank of England, 50 basis points, the ECB, 50 basis points. But they're all making weird, funny sort of noises about, well, we might close the end, maybe inflation's easing back a little, etc. And of course, the RBA next Tuesday. Wonder what they'll do. But, there's a lot of countervailing information as to what's really going on. And I'm not convinced, I don't know whether you are, that inflation is really being beat yet.
No, I don't think it has. I mean, like I did a Twitter thread about it a couple of days ago, and I compared major developed world economies, so Australia, the US, UK, and Japan. And if you look at core inflation, none of them have. Sorry, if you look at core inflation and exclude things like used cars, there's not really any real major evidence that inflation is moderating the way that a lot of people are talking about. And even, if you do sort of take the viewpoint that, you are starting to see certain things come down, it's nowhere near in any way consistent with a swift return to the 2 or 3% inflation targets that are the guideposts for the developed world.
No, that's right. And of course, the markets, they sort of listened to the report from the Fed and thought, oh, okay, lots more rate hikes. And then when Fed Chair Jerome Powell actually started talking at his press conference, he sort of sounded a bit more dovish, and suddenly the markets, oh, whoopee, maybe it's all over really. The markets are just so skittish at the moment. But if you look at the data and, objectively, yeah, sure, there are a few downward movements, but there are also a lot of upward movements and sideways movements. And look at wage growth, for example, in the services sector. We've had some relief from gas prices, but of course in Australia they're going up. But there's not enough evidence to my mind to really prove that they're going to get anywhere close to their 2 to 3% or 2% target anytime soon. So I'm not sure what the markets are smoking other than hopium, really.
Yeah, and I mean we had the sort of big some of US big tech earnings reports overnight. The likes of Amazon, Apple, etc. Surprising to the downside. And I think, that's a bit of a signal that, all is not well. But I think we're in this really interesting sort of divergent point whereby you look at, say, something like, say, in the US, at the ISM services PMI, it is deteriorated significantly.
Yep.
You look at, admittedly, there's a big difference between the S&P and the ISM, but, well, that's a debate for another day. But, that you look at some of these forward indicators, and, yeah, they are rolling over. But I think part of the issue is that as you do start to see financial conditions ease, which is basically a composite measurement of a bunch of different things, including bond yields, volatility, bond spreads, etc. But as you start to see financial conditions ease, you're starting to see resurgent inflation in places. Like, for example, you and I have been talking about this for a long time now, but US used car prices are rising again.
Yep.
And the US new car market just had its best month since I believe it was April 2021. So there are those pockets of demand driving inflationary pressures, but I'll get to that in a little bit more detail in the slides.
Yeah, well, we'll get to that in a second. It's interesting because the Australian data came out today for new lending, right? And of course, lending for housing, new loans dropped again. Refinancing came back a bit. But interesting, there was a huge bounce in lending for holiday and travel. So again, you've got this really mixed message. There are some sectors doing better than others. That's why I think there's a lot more complexity going on than below the surface. But let's get into the slides, and we can start exploring that in a bit more detail.
Okay. I've actually got a good slide later about how the travel situation is playing out in the US. So we'll get to that a bit later in the slideshow. And as usual, all the slides will be available for you to have a bit of a closer look at avidcom.substack.com, and we'll get right into it. And here we've got Jerome Powell undecided whether or not he wants to be dovish or hawkish.
That's a lovely one. And what's interesting about that, just quickly, because the markets had an opportunity to hear him say, "I'm really worried about how strong the markets are." But in the press conference, he didn't say, "No, it's all right. We don't mind a bit of. We're looking longer term rather than short term." Right? It's very interesting.
It is. I do wonder if there's a bit of a hand there of the old politicians and political influence, sort of weighing things down. I mean, I think Powell is concerned about his legacy. And I think that a bit of, froth in the market is not necessarily going to undermine his legacy as long as he keeps the hammer down sufficiently. Now, whether he does or not, that's another matter.
Yeah, I think that's a really good point, Tarric. And I think there's a bigger agenda rather than just the short termism. But the market said, "Well, whoopee," and of course pushed all the indices up. Interesting times.
Indeed. Okay, now, since we recently had the end of the month, I thought I'd do a little bit of an update on the Aussie housing prices chart, which basically breaks down the capitals on a month-by-month basis. Basically, Sydney and Melbourne, very slight moderation in price falls, but I think that is arguably down to low transaction volumes, which we've seen transaction volumes basically collapse to the lowest level in at least the last 5 years. And I think that is somewhat containing price falls somewhat. However, price falls have once again started in Perth, and we've seen a relatively significant increase in price falls in Adelaide, which is now looking a little bit more vulnerable.
Absolutely. And of course, Tassie, if you look in the last month, Tassie prices dropped pretty much as Brisbane did. So, no one's really going to be hiding, I think, from these falls now.
No, and that's a good point that I'll show in the next chart. Now, I don't unfortunately have the data to be able to provide a full-on capital city picture with the clarity in the previous chart, but I do at least have this one from CoreLogic that shows that we are now seeing falling prices on a month-on-month basis and also on a quarter-on-quarter basis across all of the capitals in Australia. So I think it's interesting to see that, you're starting to see just the weakness become more broad-based. You're starting to see price falls accelerate. And it's going to be an interesting one from here because we still, as the chairman of the CEO of ANZ came out today and said that mortgage arrears on ANZ's books are at their lowest level ever. So this is what it looks like under basically ideal conditions in terms of stress on households from that particular perspective. But as we all know, that doesn't necessarily tell you how the mortgage is getting paid. Is it getting paid because someone's going to a food bank? Is it getting paid because someone's robbing Peter to pay Paul? Or because they're taking out an equity mate loan in order to pay the bank its own money?
Yeah, or indeed have a restructure, or in other ways negotiate with the bank to be able to actually pay less rather than more. There's a lot of that going on below the waterline at the moment. And as a result of that, whilst the banks can, from a headline perspective, say delinquencies are very low, there's a reason for that, and it's not just purely the fact that there are no delinquencies. There are various arrangements in train.
That's actually something that I wanted to ask you about in terms of, because basically, the concept of rising rates is taking cash out of households' pockets so they can't spend it to reduce inflationary pressures. But that got me thinking because, I've had quite a few discussions and debates with people about this, that, a lot of people are saying, well, that then households can just go to interest-only loans. And depending on a household's individual circumstances, yes, that may be the case. But that got me thinking, if households can just take the interest-only option and end up paying basically maybe a little bit more than what they were paying before on their loans, do you think that we could end up with a scenario where we do see a big uptick in the number of people on interest-only loans, but then monetary policy is less effective at containing inflation?
Yeah, absolutely. Well, we're certainly seeing a number of people being encouraged to move into the interest-only environment. Remember that 3 or 4 years ago, APRA clamped down on interest-only loans. Why? Because they were concerned about the risks of interest-only loans, because, of course, people still have to repay the capital later. But it's like that lesson has gone away, and now everyone's saying, well, okay, well, if we can get you through the next year or two, hopefully interest rates will come back down again, and then you can start making repayments on the capital later. But you're right, it absolutely does blunt monetary policy. And if you add equity mate into that as well, and some of the other things that are going on, including, of course, buy now, pay later and those things, there are lots of forces pushing against tighter monetary policy. And I have a feeling that's one of the reasons why we are seeing still some momentum. And I go back to that issue about a lot of people decide to borrow to take a holiday, right? Because they haven't had one for 3 years, and over Christmas, New Year, we're just going to do it. So I wonder whether some of those factors are actually effectively dampening any impact of higher interest rates, which, by the way, may mean that the RBA will need to go significantly higher.
Yeah, I mean, like I had a question from a Twitter follower earlier today. Basically, someone posted a big chart of the inflation rates and the core inflation rates of a bunch of different countries, and people were saying, well, why is Australia's rate so low? And I mean, obviously the answer is, protect the housing market, hope that you don't kill the economy in the process, etc.
Yep.
But I think that the path back to 3% is quite a challenging one. And if we do start to see these sort of, I think part of the problem is that we're still operating under this idea that things are the way they were before COVID. Now, I don't think that's true. I think that things have changed dramatically in terms of spending patterns, in terms of people's priorities, and I really do wonder if we're going to basically just see people just continue to spend and just try to live their lives as best they can until basically the wheels fall off, because they had 2 years of basically not being able to live their lives. And to be completely honest with you, I think that's a perfectly understandable psychological response to that.
Well, I think that's partly it, and also I still think there's a very strong undercurrent of the government will save us like they did through COVID, right? There are a lot of people in my surveys who are feeling the pinch, but they're just holding their breath waiting for the government to put more stimulus in, or some other way to solve the problem again. Now, whether that's actually a true expectation, it's certainly a real expectation among quite a few people, and that is an interesting challenge for the government, bearing in mind, of course, that they keep saying, well, actually, our debt levels are pretty high and our ability to support the economy is limited compared with where we were. Not sure how you square that circle.
Yeah, I think you're right. I think that we've got this interesting situation where, I talk to people who are going to find themselves in a fair bit of difficulty, say like when they come off a fixed rate loan, or, when basically just the fact that, they bought at a time when rates were low, and now they've faced their interest repayments double, or even in some cases triple. And I think that we've just got this really, really strange situation where the belief, I think, that the RBA and the government won't allow anything bad to happen is really, really quite ingrained in a lot of people, probably more ingrained than it's ever been before. And, I think that we already had a fair perception, even before COVID, that the government or APRA or someone would wave their magic wand and make all the bad things about the housing market go away. But I think we've reached a point now where that is really just, I wouldn't necessarily say it's a majority viewpoint, but I wouldn't imagine it's all that far off for people who are in that vulnerable position.
Well, it's interesting because the new head of APRA came out the other day and said, well, we could always shrink the margin on the, that 3% that we've got at the moment if necessary. I'm thinking, yeah, sure, that's a really bright observation, bearing in mind where things are. But people will pick that up and say, well, they're going to help us there. They're going to actually reduce the margin. I'll just remind everybody that's only on new loans. That won't affect loans already having been made. So the impact might be quite limited. But that's a good example of where effectively those in the regulatory environment or in the government environment are giving perhaps a bit of mixed messaging in terms of where things are and what needs to be done. And then, of course, the RBA a couple of days ago said, well, yeah, we've got about 800,000 facilities that are actually going to reset through the course of this year. Facilities, not households, by the way, and very clear and important difference between the two. And those fixed rate to variable rate or fixed rate to new rates are going to be quite a significant shock. 350 billion, I think, was the number they were quoting. So, there are some really, really weird things going on. And I have to say that I'm very unimpressed with the line of questioning from the Parliament, because they were basically querying the RBA on this. They didn't really seem to get into the real critical issues that I think need to be talked about.
I think it's kind of, how do I say this politely? Insane. Probably the best way I can put it. That we have, you look at let's sort of, we'll leave out the UBS liar loan survey. We'll leave out all, the Finder survey into people who lied on their mortgages, and we'll leave all that stuff out of the equation, right? Let's just look at it purely from the RBA's own data.
Yep.
They say that 14.6% of borrowers are going to end up with negative spare cash flow with a 3.6% cash rate. Now, if not for extend and pretend and APRA and the government waving their magic wands, you would be looking at a fairly major sort of housing crash scenario if that was allowed to play out over time. Would you agree with that assessment?
Totally.
If we had a magic, free market?
Yeah, in a free market, it's the marginal borrower that is always the one that tips over, and that creates the change in the overall market. So it's not everybody, it's just a small proportion. And I reckon that 3 to 4% of households at the end of difficulty will be sufficient to really drive the market in a different direction. You don't need 14%. So if we do get 14% negative cash flow, and going back to what you said earlier on, a lot of people are in negative cash flow, but they're solving the problem by cutting down elsewhere, or what they're doing is borrowing differently, doing other things to sort of keep their head just above water. But there's a limited amount of time that you can go on doing that. And that's the thing that I think a lot of people haven't quite woken up to, right? So they might just about be able to keep their heads above water at the moment. Rates might go a little higher. But what happens if they're in that same position in a year or 18 months? And it's worth just reflecting again, it was 3 years after the global financial crisis that the peak of defaults happened in the US. It didn't happen in the first year, the second year, it was in the third year. And that's quite typical. These things take a long time to work through. And then, of course, in Australia, where we have full recourse, people will do everything they can possibly to continue to pay those mortgages. But they'll have to cut down and cut back elsewhere, which puts a lot of social and economic pressure on a lot of households. And I think I've said before, I'll say it again, debt counselling services never been busier, food banks never been busier, even now. So there's a lot of sort of leading signs of trouble and stress. But of course, a lot of people prefer to look the other way and say, oh, it'll be all right.
Yeah, I think that you're right. I think that one of the key functions in all this is time, because time is what is currently underpinning the idea that there will be intervention. If we're sitting here in a year's time and the intervention that we've seen has been, let's call it relatively limited compared with COVID. So I'd be talking about something like, say, APRA changing the buffers, or a new first homeowner grant in the mid-year economic and fiscal outlook from the government, right? So like sort of relatively normal levels of intervention. If rates are still this high or even higher, potentially, Deutsche is talking about 4.1%. Yep. You talk the guys at, what was it? Your mate Steve, who from the comparison website, I forget his name.
Canstar. Steve
Canstar. Yeah, yep. Canstar. Tip of my tongue. And they're talking about a cash rate going even higher. If we're talking about like a 4% cash rate a year from now, people are going to be in a fair amount of trouble.
Yep.
And there's not really a whole bunch that you can do. You can do about that with the scope of intervention that they have today.
And two other factors just overlay. Real income still growing lower than inflation, and real cost of living, according to the ABS data this week, much higher than the CPI, close to 9%. those are the other two factors to put into the mix.
Yeah, absolutely. I mean, you're talking. I mean, like in the last 12 months, inflation has outstripped wages by 4.7%. So that is basically erasing almost a year worth of pre-COVID wages growth every month.
Yep.
And that is one of the reasons why I really, really, really dislike this idea that, oh, no, we can't raise rates. Oh, no, we can't do this. It'll break the economy. There'll be a recession. What is worse? A recession that you can have for 6 months, 12 months, 18 months, that then tames inflation. The government can do counter-cyclical support. They can provide support for people in need. They can, sort of do things to, kickstart industry, etc. Is that worse? Or is it worse having decades and decades worth of real household spending power being destroyed and then taking decades and decades to get back to where you were, and basically putting the entire economy in a position where it's even more reliant on people saving less and taking on more debt? I don't see how that's better, how it's better to just put your country in a position where it's basically having a lost decade every year in terms of real incomes and doing that type of damage, and how that's better for the economy in the long run, because frankly, it isn't.
Well, the UK is a great example, right, where they've gone through that journey since the global financial crisis. And in fact, last night, they showed that they don't expect the economy to grow back to where it was back then for years. So they've got this decade of stagnation, decade of shrinking economic value, wages going backwards, overall momentum going backwards. And that's an economy that's still quite well supported by some of the biggest petroleum, like Shell, for example, petroleum entities who reported 32 billion profit, right, which is massive, right, but not enough to support the total economy. I mean, this has all the hallmarks of a mega stuff up, as you say. Sometimes the right answer is to take your medicine, let the recession get a grip, squeeze out some of the pain, as it were, do it relatively quickly, and then start up again. If you try and protect everybody and just sort of let the thing bubble on, which is what the UK did, you end up spiraling down and potentially getting to a point where growth is even slower, and economic momentum, so far as households are concerned, is even slower. And that actually still takes you to a pretty terrible place and no way out.
Yeah, exactly. It's trading, short-term pain for long-term gain versus long-term pain. And, I don't even really think you could call it short-term gain. I mean, I guess not having a recession is a gain, but I mean, we are staring down the barrel of a scenario where even if the RBA's heroic wage forecasts are to be believed, and good luck with that, where we're going to be running a 2023 or 2024 economy on 2008 levels of real household incomes per capita.
Yep.
Which makes the country even more reliant on immigration and more reliant on all these other things that basically, well, no, I should say, extremely high immigration. There's nothing wrong with immigration. Immigration is great if it's run at a sustainable level, like it was for most of Australian history.
Absolutely. And of course, the other issue there is that if in fact half of the economy is actually household consumption, and households have less ability to consume because their wages are going down in absolute terms, and they're spending more and more of their disposable income on trying to find somewhere to live, either to rent or to buy, that's an economic spiral that was also going in the wrong direction in terms of overall economic outcomes. So, you're quite right. Migration can lift the total GDP perhaps a little bit, but GDP per capita, which is a better measure, continues to go backwards.
It's all right. We'll just cut rates to negative 2% and just equity mate to the moon.
Yes, why not?
Okay. All right. Now, this is a really, really interesting little analysis from UBS on which households have the savings that were made since the pandemic started. And, well, the answer is the 65 plus age group has the most, followed by the 55 to 64. For the 35 to 44, well, that's not so good. They, in the 2021-2022 financial year, they saw their savings actually fall. So I think that we're in a position here where basically we have a older Gen X / baby boomer powered economy where they have all this cash that they're sitting on that they could spend and that they may spend, and that will be, if they playing their cards right, generating a fair amount of interest that if they get themselves a nice little term deposit or savings account that could continue to keep spending elevated, even while other people, and particularly mortgage holders, potentially do it quite tough.
Well, it is this, again, K-shape, as we've spoken about before, right? So there's a sector doing quite well, there's a sector doing less well, and I agree with that rough age characterization. It's not perfect, but it's good enough, and I see it in my own surveys too. There are a lot of people who actually do have a lot of assets, a lot of free cash, and have the choice to spend, but there are a whole lot of people who are really up against it, have very little wriggle room, and are just about clinging on. Unfortunately, there are more on the clinging on, right? It's like sort of everyone's been thrown in the water, and you've basically got over there a bit of an island, and people are clambering up onto the island, but there's not enough room on the island for everybody. So there's a lot of other people swimming around, trying to hang on. That's how I feel about it at the moment. Unfortunately, quite a few of the decision makers are in that. They're on the island and they're quite happy and they're dry and they're thinking, well, this is pretty good. It's a lovely day, nice view. We'll just look away from all those people swimming in the water and struggling. Whereas there are a lot of younger people who are really a long way from the shore and having to work really, really hard just to keep their head above water. That's a bit of a blunt analogy, but to me, it's a pretty good analogy of what's going on.
Yeah, it's sad because you're basically just seeing this bifurcation of society along age demographics.
Yep.
You've seen boomers get wealthier and wealthier. Naturally, this is an aggregate statement. There are rich boomers, there are poor boomers who have nothing. It obviously varies. So it's very much a broad overview that lacks the granularity. But yeah, if those wealthier boomers do spend their money, and if we do see the household savings rate come, which I have here, if we do see the household savings rate come down further, either to, sort of like 2016, 2017 levels, or if we see it really, really, people really start to reduce their level of saving, like we saw in the early 2000s in Australia and in the US, and the US has seen savings rates collapse as well as people try to cope with inflation. If we see that play out in Australia, basically rate rises are not only cancelled out, but they're cancelled out into complete oblivion. I did just a really, really rough estimate. I'd say rate rises are probably taking out about 35 billion out of the economy in net terms a year. And, that's based on a very rough estimate because basically I've had to basically guess in terms of how much interest is being paid to savers and people with term deposits, etc. But if people save less, and we do see a reversal of household savings rates towards those lows seen in the early 2000s, you could easily see 80 or 90 billion a year added into the economy, which basically completely undermines monetary policy in its entirety. Even half that completely undermines monetary policy in its entirety. So we have this really, really challenging scenario where the RBA might have to crush mortgage holders a hell of a lot more if people do choose to spend. Now, admittedly, that is a frankly enormous if, and I'm not sure one way or another.
No, I'm not sure either. And the RBA will, of course, be acutely aware of the debt burden on those households, which is coming through. They discussed the other day. But there's a bigger picture here with the that wealth sitting in older generations. Of course, eventually those older generations will fall off the perch, and presumably that wealth will then flow back down, maybe. But that's a long term. And by the way, there's another interesting question, because a lot of that equity is actually sitting in property, right? A lot of older people have mortgage-free property. there'll be a lot of that coming on the market in the next decade or so. That could be another interesting supply-demand question for worth thinking about in terms of the way that property prices get shaped out. But yeah, I just wonder how aggressive the RBA will be and to what extent they will say, well, there are things we can and things we can't do. And as we said before, there's a bit of limitation on what the government is able to do. So there's a few very critical years ahead where I think some of this wobbly stuff is really going to show itself.
Yeah, I think we're in a scenario at the moment where the RBA basically, I'm not going to try and ascribe their motives or their desires, but let's just say I don't think that a global recession would be unwelcome, as long as it was relatively contained to, like the GFC was, to places beyond our shores and beyond, influencing our economy too much. Because if things continue the way the way they're going, the RBA, the government, they're going to have a problem, because housing prices are going to keep falling. Eventually, equity, mate, is going to dry up, just like it has everywhere else when that's happened. And you'll end up with a scenario where it's going to hit the economy, and it's going to hit the economy hard, because equity, mate, is such a huge driver of business credit and just of cash flowing into the economy in general. So, it's a race against the clock for something to go wrong, for them to be able to justify cutting rates and justify putting settings back in the direction of the way they were before. Because if we magically just see the economy hold up and inflation stay higher than, let's just say 3.5% in that sort of uncomfortable area over the next, say 18 months, maybe 20, 24 months, they're going to have a bad time. There isn't really any ifs or buts about it. You can't have an economy built on housing, built on construction, having rates that high and not having it do the job properly. So it's going to be interesting to watch, because I suspect that the fate of Australia's economic cycle isn't going to be decided here. It's going to be decided somewhere else out in the world.
I think that's exactly right. Another thought: high inflation reduces the absolute value of debt now. So actually, you could argue that central banks wouldn't mind a bit of inflation, really, because it will actually help to shrink the real debt.
Yeah, I mean, I think the thing is that, that sort of works on paper, but then you get into trouble in terms of that really works only if the ability to service the debt rises with it. So like people say to me, oh, but this is inflating away the value of my mortgage debt. But it's like, yes, but at the same time, unless you're achieving a significantly higher than average level of wages growth, it's actually potentially, depending on your individual circumstances, impairing your ability to service that debt, because you have a smaller proportion of your income to spend on that debt, because you're spending more on essentials or more on your kids' school fees or whatever it is, or on your house insurance. But I think that it's a complex picture in that regard.
I agree. Certainly is.
Okay, now this I think is an interesting one, because it basically shows that since the early 2000s, the largest growth in spending by age demographics has been older generations. 65 plus has been the largest, then 55 to 64, and so on and so on. You can see that on the right-hand side there. And basically, you can see that for the under 34 generation, well, things peaked in the late 2000s, and even for people in the age 35 to 44 generation, things really aren't all that much better than they were in the late 2000s before the financial crisis. So the real growth in consumption has actually, on a per capita basis, has actually been from older generations. And I think it's also just worth noting that this data only covers up to 2017, 2018. And since then, those generations have been enriched further, to a fairly significant degree, even further, by, the housing price boom, by rising share prices, you name it. So I think that, we're looking at increasingly at what I would call a boomer-powered economy.
You've never had it so good if you're a certain age and a certain set of characteristics. As for the rest, wow, good luck.
Yeah, well, basically, I mean, there's a reason why, if you look back, real household disposable income per capita
Hmm.
prior to the various COVID interventions and JobKeeper, etc., it basically went nowhere for the better part of a decade.
Yep.
If you were just an average everyday Joe, you had a worse decade than Japan's lost decade. So, yeah, I think that really needs to be put into perspective sometimes, because so much of Australia's growth and success in the last 10 years has actually been more about immigration pumping the headline number and, frankly, just the success of the resources sector.
Immigration, houses, and holes.
Australia.
That's all there is.
Pretty much, mate. Okay, now this is an interesting one. I've been talking about this for a while now. We've actually seen US consumer confidence bounce about 30% since its lows in the middle of last year. Now, I've been thinking on this quite a while as to why. And basically, I just think that things haven't gone as badly as people initially believed they would. A lot of people were expecting a recession in 2022, and technically you got one, but not one as defined by the US National Bureau of Economic Research. And things just haven't gone as badly as people thought they would. You said you had, the CEO confidence survey talking about a recession, and it hasn't happened yet. People have just continued to spend, and that goes back, I think, to the psychological change that we were talking about earlier in the show. But if this does start to translate into more consumers spending more, even if it's only on a relatively limited number of categories, it could further stoke inflation and complicate things for the Fed. And we'll get to it in a couple of slides' time, but I think we're starting to see some early evidence that is occurring.
Yeah, and of course, wages in the US are still quite strong. And if you think about that, if wages are actually reasonably strong, then that gives people more ability to spend, and their confidence level automatically rises. So I think there's probably a correlation there as well.
Yeah, that's a good point. I concur. Now, one of the reasons why we also may have seen confidence levels rise is because we've seen financial conditions loosen.
Mm.
Now, as we've discussed earlier in the show, this is basically a composite measure based on a bunch of different things, but one of them is bond yields, and by extension, in particular in the US, mortgage rates. Because unlike Australia, where mortgage rates are very much generally linked to the RBA cash rate, in the US, they're linked much more heavily to long-term bond yields, because I would say somewhere around about 95% of US mortgages are on fixed terms of somewhere between 15 and 30 years. So as mortgage rates have fallen with the bond market, you're starting to see people go, well, you know what, this economic cycle isn't so bad. Maybe I should spend a bit more. Maybe things will get a bit better. Maybe I'll get that new house.
Yeah, and interestingly, of course, that financial conditions index, that caused a bit of a stir, because Powell basically said, well, financial conditions have actually eased considerably, right? And a lot of people said, no, well, is that right?
Well, he's completely wrong by any metric. There's the Bloomberg index, there's quite a few different private indices, and then there's also the St. Louis Fed financial conditions index, which is done by his own organization.
I know. I was thinking,
yeah. Someone said that they reckoned that maybe it was a COVID brain fart, that he's just got a bit of brain fog and he didn't know exactly what he was saying. But if that's the case, that's a hell of a screw up.
Yeah, pretty big.
Yeah. Now, one of the places that we've seen this resurgence in demand is US used cars. And this is something that I've been talking about, probably too much potentially for some of you, but we've actually seen used car prices bounce in January. We've seen them bounce by about 2% in some cases. Now, that is going to throw a massive spanner in the works of the month-on-month CPI figures when it finally feeds in, because we've seen big drops in US used car prices over the last few months, which has driven some fairly significant falls in the month-on-month and year-on-year CPI. But if that's about to, moderate even for a couple of months, it's going to throw a real spanner in the works of the inflation is over the sort of narrative.
Yeah, absolutely. And there are a few other categories, right, which are still haven't fallen over in the US as well. So, there are still many elements which are suggesting that the inflation story is not dead. It might just have shifted a little bit. And there's still this question of the rent question in the US as well, because some people are finding that rents are going up, others are going down a little bit. But the only thing you can say is that we know that home values in the US are falling quite quickly. But interestingly, if the bond yields continue to move, that's going to put downward pressure on the mortgage rate, as you said, long-term fix, right? Well, that could give another stimulus cycle component there to the housing sector in the US.
Exactly. And right now, because financial conditions are loosening, the thing that was meant to do the heavy lifting was the hit that the housing sector was going to take. But if that hit isn't going to come anywhere near as heavy or as swiftly as was implied, and there's still a big stock of projects that still needs to be completed, you could see monetary policy not be as effective as originally intended. And I think that is a scenario that could really screw things up for the Fed, because they're not, well, let's just say they're not doing their job properly. You can't have financial conditions loosening like this. They should be stomping on things as much as humanly possible. If rising rates isn't working, then they need to increase QT. They've got to do something.
Yeah. Well, the other factor, of course, is there that whilst they are taking liquidity out of the system, the Treasury is quietly putting money into the system, right? One of the reasons why the debt ceiling is now being spoken about. So you've almost got the shadow of Fed in Treasury land, Yellen land, pulling in a different direction to the Federal Reserve.
Yeah, exactly. And not only that, but you've also got the People's Bank of China. I mean, I read one report recently that suggested that in recent months they've injected, in net terms, about $500 billion worth of liquidity into the global financial system. So, that is counteracting all the bond sales and the quantitative tightening that is being done by the central banks in the rest of the developed world.
Absolutely. Yeah, well, it just shows you that how complicated and interconnected this thing is, not just nationally but internationally. And China being one of those other factors that's moved very quickly over the last month or two, and they've taken their target rates down a little, so the banks can throw more liquidity into the system, and a lot of that liquidity is flown around the system, and interesting times.
Yeah, pretty much. Now, this is an interesting one, just on what you mentioned before, that you could see the US housing cycle shift, because if you look at consumer confidence data, we're actually starting to see the intention of buying a new home in the next 6 months rise to its highest level since 2019 levels. And we've also then seen a sympathetic move from lumber. And I do wonder if the commodities market might just be sensing something, that perhaps the Fed isn't going to stomp on things as much as they should have, and that this cycle isn't going to play out quickly, and that maybe, just maybe, there's going to be more demand for commodities, which is going to see inflation get fired up again.
Yeah, another great example. And we said right at the start of the show, there are some indicators that are saying things are going rather differently to the way that they are being reported officially. Right, this is a great example of that. And I was speaking to somebody in the US the other day who's actually very much connected to the property sector, and he said, last couple of weeks, something has changed. There's suddenly more inquiries, there's more interest, and people are coming back into the market. So yeah, there has definitely been a change of sentiment quite recently.
Yeah, I agree, and I think it's all about rates. It's all about those mortgage rates coming down.
I agree.
And this is another good example that like we were talking about just earlier in the show, the strongest auto sales since May 2021. That's not something that you see in an economy that is tanking. There's this resurgence in spending, and I think it is very much worth noting that it is it's perhaps a minority of people there are a lot of people doing it tough, a lot of people doing it very, very tough. But then there's also, as we talked about, that K-shape, there's these people at the top who are seeing their fortunes rise, who don't have any problem, who have also experienced that psychological change from COVID. And, rather than saving or investing or whatever, they're getting out and they're getting that new car. They're going on that holiday. They're doing whatever it is that they want to do. And I think that the Fed hasn't accounted for that. I don't think any central bank has.
No, I was going to say, I think it is not just the Fed. I think it's true here. I think it's true in the UK as well. And going right the way back through, people had their lives put on hold for a couple of years, 3 years, and now they want to sort of get back and get on. They've got the funds to do it, so why wouldn't they? And this is quite fascinating insofar that the supply chain disruptions were part of the reason why the supply side of auto was gone off the boil. That, of course, is sort of fixed a little bit now. So the supply of new cars to buy is actually up a bit as well.
Yeah. No, I mean, we are starting to see that sort of normalization of things. And I think it's just going to be interesting to see how long this sort of, bullish optimism holds up. Because, you are seeing these signs in used car prices, new car prices, intentions to buy homes.
Yep.
You are starting to see this shift. And there is the potential that this shift becomes self-sustaining, because the demand drives this positive cycle within the economy, and we do perhaps see a surprise to the upside. Probably not in Q1, maybe in Q2, but then the question becomes, well, what does the Fed do? If the labor market is still extremely tight, job ads are still well and truly above a level consistent with keeping the unemployment rate steady. So, what do? Do they just take rates higher? And at that point, the RBA and the rest of the world gets dragged along for the ride.
Well, Andrew Bailey, who's running the Bank of England, said, there is a narrow path to get inflation down, but there's significant, a variety of risks to the upside that would mean inflation is going to hang around for longer, which means we've got to put rates up higher. So he's still recognising some of these things too, but hoping, fingers crossed, that he can sort of steer his way through. I think there's a lot of hope in a number of central banks at the moment, not least our own. But if some of this data translates the way that we're interpreting it, they're going to have a real problem on their hands.
And there's also just the other factor of a reopening China as well.
Yep.
If we do see this bullish outcome that everyone's talking about, that China has this great economic resurgence, well, we all know what that's going to do, especially to some of these commodity markets, say something like copper, where inventories are at a low level. You're seeing geopolitical issues potentially impacting supply from places like Peru and other parts of the world, and then you've got a bit of a perfect storm scenario. I mean, I'm not saying that that's how it's going to play out. Personally, I'm not sure one way or another, but I think that is a scenario that's well and truly on the table, where you do start to see a resurgent US consumer, and then you have this issue with demand coming in from China for these commodities that ends up putting up further upward pressure on inflation.
Yeah, and you make a very, very important point, and that is that our own economy is so connected to what happens in the US and China and the Eurozone. We'd have very little ability to make our own decisions off our own bat. Okay, we have our own currency, but with there's limitations to that. It really is going to be a question of what happens in those big economies in the Northern Hemisphere and how that then translates down here. It's not a very comfortable position to be in when you actually aren't in control of your own destiny.
No, and I would just add that part of the reason why the RBA has been able to be, let's just say, relatively dovish compared with other central banks is because we have seen that downward pressure on bond yields for since they peaked in 2022. If instead bond yields were higher and that spread between US and Australian bond yields was blowing out, as it was earlier in 2022, and putting downward pressure on the Australian dollar, well, then we'd have a problem. Because then you've got inflation and a weakening currency, and eventually you need to choose to either let inflation run rampant, which has its own, Pandora's box full of problems, or you raise rates, got to take rates even higher in order to protect the value of your currency, as many, many different central banks have done around the world. So there is this big question to me, that is what we've seen in bonds a bear market rally? is the the bear market, is the the sort of downward pressure on yields over? So is the downward pressure on yields going to continue, or is this just going through the motions in the same way that you would with a bear market rally in a stock market? And we're going to actually see yields rise again if data surprises to the upside, and if inflation sticks around for longer than the bond market thinks it will.
Yeah, and it is interesting because there are some analysts who are absolutely calling it like that this is an aberration, and quite often in a bear market you get these relief rallies that are quite strong and then they come down again. And a couple of people I was reading said, well, I'll know in 6 months' time whether one or the other, right? And that's probably right. You won't know until it's a bit too late. But certainly there are some arguments to say that the rise in stocks and the adjustment in the bond yields, this might be a real turning point, or it might just be a bit of a shadow, and it'll go back and start moving the other way again. And of course, which of those two outcomes ends up will completely change the calculus in terms of interest rates, monetary policy, and a whole bunch of other things. So you can see how difficult it is.
It is, and I think that we've got a scenario here where basically that could be the worst of both worlds. If we were to just have central banks crush financial conditions, crush the market, send a bunch of different nations into a recession, well, that would be bad. Well, not bad, it'd be challenging. But by the same token, that's what they've done every time inflation's got out of control. So it wouldn't exactly be without historical precedent. But the problem is, the longer this cycle goes on, the higher rates are going to have to go. So if we end up in this scenario where rates are having to stay higher for longer, where, let's just say because of insufficient attention to financial conditions and because of changed pandemic-driven changes to cultural spending patterns, if you end up with a scenario where things hold up for another 6 or 9 months, you're going to have a really, really unpleasant time in terms of having to take rates even higher. And eventually that is going to bite. It's going to take time because, as we all know, rates don't bite immediately, particularly in the US where, people have fixed rate mortgages, but they do bite eventually. And when they do bite, they bite hard. So, if they are forced into that position, you could end up with a scenario where, you get the recession in the end, but only after the economy has been even further hollowed out by inflation.
Absolutely. It shows you how precarious things are, I think, generally.
No, I thoroughly agree. Now, this is what I was talking when you mentioned earlier about the spending on travel. This is from American Express, and basically, well, as you can see, people are going off tap with spending on restaurants, hotels, airlines, you name it. And, there is that subset of society who's doing very, very well. And if this does feed into demand for these things on over a protracted period, well, the airlines and the hotels are going to turn around and they're going to go, well, if we can jack up our prices and we're still going to have full occupancy or full planes, then that's exactly what we're going to do, which will feed into inflation in particular the services sector. So I think that's worth keeping in mind.
Yeah, no, very interesting, Tarric. And interestingly, I've had a couple of approaches from potential clients, wanting granular information about spending profiles in Australia, and specifically interested in the travel sector, right? And what's really going on in it, because they're not sure that the data that's coming through from the ABS is current enough to be relevant. So they're trying to find other routes to get more up-to-date information with regards to people's plans, people's intentions, frankly, people's optimism or not. So this is, I think, a big issue, and I do think there's a big amount of momentum here that has yet to really been shown coming through in some of the data.
Yeah, and I think it's just worth noting that we were talking about recently how the CPI weights were changed, how things like utility bills and rents were reduced, had their weights reduced.
Yeah, guess what was increased?
Yeah, exactly. Travel
and leisure. Yeah.
Yeah. So if we're going to see a similar trend here in Australia, well, the ABS has changed to the weights might not end up putting downward pressure on inflation after all. It might end up doing the complete, either just cancelling it out or doing the complete opposite entirely.
Well, that was one of the reasons why the numbers were higher than expected last month, because there was a bigger travel and leisure element than people expected. So,
yeah, it's going to be interesting.
It certainly is.
All right. Last chart for the week. This one is an interesting one because, we're talking about, these people spending big dollars on travel, big dollars on hotels and trips out to fancy restaurants. But, well, subprime auto loan delinquencies they're higher than they were during the financial crisis and they're climbing quite rapidly. And, this is, I think, is going to be an interesting one to watch because even if you do start to see a resurgence in the economy of the haves, it may not spread into the economy of the have-nots, which could create some quite challenging conditions, both economically and socially going forward.
Very interesting, Tarric. I was talking to somebody who's in the insolvency sector, and he was telling me that he's had a significant rise in people knocking on his door for advice and help over the last few months. And he said it started with those small and medium enterprises who actually got caught through COVID and were protected, and then their protection eased. But he said more recently, he's got another spate now of, again, small businesses who actually got through COVID okay, but are now beginning to find that this change in the weather with regard to interest rates are actually creating huge issues. And one of the observations he said to me was, we're going to see quite a lot of commercial vehicles coming up for sale as part of disposals, simply because of these businesses effectively going pop.
Yeah. Well, I mean, like even in my own used car data, every week is another new record high for the data set. You're starting to, you're still seeing cars being added extremely rapidly, and there's no sign of it ending. We're already above the levels that I've seen, and even that other people have shared snapshots from years prior that show that we're well above those levels, even those levels under more normal circumstances. So it's going to be really interesting because, we could be sitting here, in say 4 or 5 months' time, and instead of there being 75,000 cars on the market or thereabouts, there was prior to COVID and in the years before, and this is just on car sales for private sale, if anyone was wondering, we could be looking at 100,000. And then all of a sudden, you're going to start to see, these big drops in used car prices, which is interesting here in Australia, but thankfully not really related at all to the CPI.
Yeah. Oh, that's at least somewhat useful because we don't count it in the numbers, right?
Yeah, although I will say one thing that's really interesting is people have said to me, but core inflation is down in Canada and in the US. And I said, and I looked into it, and guess which two countries have used cars as a major input into the CPI?
Funny that, isn't it? Yeah.
Yeah, well, it's interesting. I think that it's going to be really fascinating to watch how all this plays out, because so much of what's going on in the world of inflation at the moment is just, it's either because of energy prices or because of these types of distortions. And once you remove those, I think you start to get a better idea of how long this could all take to play out.
Well, I've said a couple of times, I'll say it again, it's a number wang.
It is a bit. I mean, like one of the things that really frustrates me sometimes is the way that Americans like to annualize everything. Like there was these big, huge changes that I believe we talked about a few months ago about in the US healthcare, the health insurance, where they revised it down enormously and put all this downward pressure on services in the CPI. And that's not going to happen every month.
No.
But let's annualize it anyway. So,
well, they do it with GDP as well, It's just
I know. It's so frustrating.
Fun times. It just shows you that you can't take the numbers, at face level. You've really got to get behind them and understand what's driving them and how they work together, which is why these chats are pretty important, I think, because you have to come down the layer to really understand what's going on.
Well, I agree. I mean, we've talked about the issues with retail sales, which I might add that we got completely right. And that December did surprise to the downside because of the issues with the adjustment, which we talked about back in October. And, we've even talked about the issues with the sample rotation in the labour market data. and that continues to be that continues to be an issue. So,
Yeah.
It's really just worth just taking the time to just see what's going on under the bonnet, so to speak.
Absolutely, folks. If you want to know what's going to happen in the next quarter, listen to us. We're a finger on the pulse.
No pressure there at all.
No pressure at all. No.
Yeah.
Said without any, full disclaimer, we don't know what we're talking about, but we just got a few ideas. But it does make the point that go down and look at the detail. It really does tell you something quite different from what the top level analysts are reporting or what the markets are saying. Right? There is another narrative here that is really worth watching at the moment.
No, I thoroughly agree. I think it's a really, really complex picture. And it's so easy, especially for the market right now, to just find these positive narratives, this promise of these Goldilocks conditions, just because a lot of people don't want to confront the alternative because I think it was one of the executives from BlackRock coming out the other day basically saying, if there's a recession, it's going to be very, very mild. And I think the truth is unless we get very, very, very lucky that the largest and the largest and swiftest relative tightening cycle in history is going to end quite a bit differently than that.
Yeah, I tend to agree, Tarric. I think we've only started to see the first steps through this. And I think that, the end of the beginning is perhaps where I'm at in this journey. I think the next 2 or 3 years will play out. I think it's going to be much more complicated and difficult than some of those analysts. But then analysts are only interested in convincing you to go buy stocks or other assets. So what do you expect?
In some cases, yeah, it's a bit unfortunate, really. But at the end of the day, it is what it is. That's the way it's always been. But I think it's just like you say, it's just important to just try and have a bit of a wider look at things, and just confront the things that potentially make you a bit uncomfortable, and maybe you're a bit unpleasant, because they are possibilities on the table, and we'd be remiss to ignore them.
And that's the end of this week's unpleasant show.
Well, I think that there are probably quite a few, well, a very small group of people who would classify us thusly, but
It is. It is what it is.
They add to our audience, mate. Think of it that way.
Exactly right. Yes. Well, you know who you are. Tarric, thank you very much indeed, as always, for preparing the slides and taking us through the very, very important messages there today. And I'll look forward to the next one in a couple of weeks' time.
Yeah, sounds good, mate. Looking forward to it.
See you later. Bye-bye.
Bye.